Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is David Albrycht, President and Chief Investment Officer of Newfleet Asset Management. David, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Thanks for having me.
What macro risks do you see today that investors should have in the back of their minds?
Sure. I'd categorize it in three areas. First, the new administration with a focus on stimulus. The American Jobs Plan, along with the infrastructure, is trillions of dollars. Ultimately, that means higher taxes, both corporate, capital gains, and also throughout upper income. It also means more regulation, whether it's infrastructure, green technology, through executive orders. And lastly, rates definitely are going to go up, a reflection of the reopenings, pickup in economic activity, and elevated treasury issuance. I would categorize the impacted industries being energy, healthcare, and tech, and beneficiaries being state and local municipalities. But I'd also say in the context of the virus, scientifically, we have 5 vaccines. We were up to 4 million vaccinations a day. Right now, 64% of those 18 and older have 1 shot. 54% of adults are fully vaccinated. You have to watch out for new variants, return to normal pre-COVID demand, but I think we're there. And then lastly, geopolitical risks. We have obviously China, Russia, Turkey, all topical. Situations have deteriorated, but really no contagion in the markets.
What risks do you see in the fixed income market?
I would say, first of all, we want credit over interest rate duration. Credit sensitive spread product, if you look at an historical valuation perspective on a 5 and 10 year basis, is fair value, but still a multiple of treasuries. We still have $14.2 trillion of negative rates globally. 90% of IG assets yielding over 1.5% reside in the US. So that bodes well for the US markets and the US dollar. On a technical front, we see massive issuance, rebuilding balance sheets, which is all good. So I'd say the easy beta in fixed income is gone. Independent fundamental analysis makes a lot of difference. You want to pick your sectors, you want to pick your credits, and valuations that are full in a low yield, low rate environment, really loss avoidance is critical.
Let's discuss the Fed and central bank policy. What do you think the direction of rates are going to be? How concerned are you about inflation? And of course, we're having the tapering conversation now.
Right. So, I think the Fed, first of all, is definitely dovish. We'll see on Wednesday whether they talk about tapering and they come a little more hawkish. That's sort of up for grabs. But I'd say that they don't want to spook the market. They want to make sure the market is orderly and they don't see financial conditions tighten. That's very important to them. As far as where I see rates going, the 10-year Treasury 1.25% to 2%. Maybe later in the year it would be 1.5% to 2%, with our bias being up. And as far as inflation, the reflation trade has definitely taken place. We see the wave of inflation beginning with, you have the reopenings of the economy in the US. We've seen supply line disruptions. We've seen increases in raw material prices. We've also seen labor shortages. And we think that wave will continue with the reopenings in Europe. So I think I agree with the Fed that, inflation is going to be transitory. My definition of transitory was probably mid-year earlier. Now, I think with what we're seeing, probably later this year, early next year, where things start to retrace back to what I consider to be a comfortable range for the Fed, 1.5% to 2%. If it gets to 3%, they're going to have to act without question. If it gets to 3% for a sustained period of time, they're going to have to act. But right now, if it gets back to 1.5% to 2%, they're not going to act. And I think that they'll continue to telegraph what they're going to do, as they always do.
So, David, with that current backdrop, what are the current fixed income opportunities since the easy money has been made?
Yeah, the easy beta has been made without question. I'd say we're still constructive on spread sectors, active over passive. If we looked at some of the top sector opportunities, out of index, off the run, asset-backed securities. Those would be like subprime auto, timeshare receivables, consumer loans. Those all benefited from the stimulus. Delinquencies are down. Actually, we have about $1 billion of exposure to subprime auto. Delinquencies are down, and about 75% of our holdings in the last 12 months were actually upgraded. Non-agency mortgage backs versus agency. Reason being is they're less sensitive to prepayments and interest rates. And more importantly, what you've seen in the agency market is everybody and their brother is buying a house or refinancing. Well, current coupons trade at 105. When you refinance, you get your money back at par. That's a negative total return. So we like the non-agency space. LevFin, we love. High yield, bank loans. Both are very lowly correlated to raising rates. We think that's important. You've been able to rebuild your balance sheets. Upgrades are outnumbering downgrades. Defaults are declining dramatically. Triple B part of the investment grade corporate arena probably is where we find the best value in IG corporates. Then I would say high yield, emerging markets versus investment grade. Definitely stick with the dollar, no foreign currency exposure, but some of the high yielders that have benefited from oil price movements, Guyana, Angola, Egypt, the Ukraine with its IMF support, Mexico, Pemex, the valuations there make a lot of sense. And then I'd just say that, probably munis a little more fully valued. However, we all know that based on what the administration is doing, taxes are going up. So there's been insatiable retail demand.
All right, David, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.